Good morning. Welcome, one and all, to your business's financial health as measured by 8 key accounts. We're grateful to Machias Savings Bank for helping sponsor this workshop and a number of others. So it's always much appreciated to have business partners in the community helping our efforts to help people start their businesses. My name is Whit. I am a mentor with SCORE in Southern Maine, and I will be walking you through this workshop today. I invite you to use the chat window to let me know the industry you're in, so that if I happen to pick any particular examples, I might perhaps be able to offer one from your industry to make things more relevant for you. And if you're coming to this workshop with any specific questions, please put them in the chat window. And if it's not something that I'm already covering at some point in the slide deck, then I will try to work it in at some point. I invite you to ask questions as they arise. Just unmute yourself and show your video if you wish. But this is intended to be interactive, and the best time to ask a question is when you have it. So don't sit on your questions for later. Please ask them as they arise. If you wish, you can use the chat window. There's always a risk that I may not see the chat window at the moment you ask the question. I do try to check it fairly regularly, but so you have several options to either put them in the chat window or just unmute yourself and jump right in. So without further ado, I will dive into this morning's content. We're going to focus on a total of 8 accounts across your balance sheet and income statement. On your balance sheet, the accounts that I've chosen as being most likely to give you useful insights and things that you should monitor regularly are your cash, accounts receivable, inventory, fixed assets, and account payable. On your income statement, for me, the most important are revenues, gross margin, and net margin. Other people may have a slightly different list, and we might disagree on which are most important. But I think everybody would agree, everybody that I've talked to would agree that these accounts are important and are very quick ones to look at and help you make sure that your business is on track. So for each of the accounts, as I walk you through them, the nature of the questions that I propose you ask yourself are, first of all, was the change significant? If it was a tiny percentage change, then it's the same as it was last period, and therefore not a significant change. Your definition of significant for your business might differ from my definition of significant for my business. That's fine. The question is this worth paying attention to? The second question is, was the change in this account consistent with what you're seeing in the other accounts, and therefore presumably consistent with the changes in your business? If your business is growing, you're going to see very different kinds of changes than if your business is constant. So is it significant? Is it consistent? Along with this line of inquiry, was the change expected? So if you're growing, you expect certain changes to happen. And so if this change was expected and in line with expectations, then that's normal for what your business is going through. Most importantly, for any and all of these accounts, why did the change happen? If there was a change, or even if there's no change, why? Do you understand why that account changed as it did? If you don't, then that's an area for some more research. It's not necessarily bad, but it's usually good when managing your business to understand why each account is changing as it did. If you look at the account and you say, yep, that went up by $5,000 and I know exactly why that happened, that's what I expected, then you don't need to give it any more thought. On the other hand, if you're not quite certain why it happened, it's usually worth digging a bit. And then lastly, even if a change happened and it was significant, and perhaps it was inconsistent with other accounts, if at the end of digging into why it happened, you don't think you could have done any better, in other words, the business was being managed as well as it could have been, then don't beat yourself up about it. Move on to the next and keep an eye on it in the future. So if it's something you can affect, then that's something to consider and try and change to improve. If it's something that really was sort of out of your control, then note it, understand its impact on your business, and move on. So the intent here is to give you a quick process you can follow every month once you've reconciled your accounts for the month, and quickly review these accounts to make sure that you're catching anything that is significant for your business. So we'll start with the balance sheet. Your balance sheet, in case you're not familiar with it, shows you what your business owns and what your business owes at a specific point in time. It does not capture changes over a broad period of time unless you ask for it to show the period you're looking at compared to some previous period. And even there, it doesn't necessarily show you what the net sum of the changes were. It just shows you those two snapshots. Now, many people, when they print out a balance sheet, also include either a dollar change or a percent change between the previous period and the current period. It's your preference which is most useful to you. Some people prefer thinking in percentages. Some people prefer thinking in dollars. Some like to see both. Some accounting packages give you the choice. Some don't. Whatever. The other thing to keep in mind is that many accounting software packages allow you to show more or less detail. So, for example, you can often collapse groups of accounts. You might have to put them into a group to be able to collapse them, but if you wish to show less detail on your balance sheet, you can. For example, if you have 6 different checking accounts and you just want to see one total checking accounts balance, you can do that in many accounting packages. And sometimes by showing less detail, it lets you look at your business from a 1,000-foot view and see things that you might not see if they got buried in the weeds of too many accounts. So, turning to the balance sheet accounts, we'll start with cash. Cash is the lifeblood of every business. Cash is king. If you run out of cash, you can't operate your business. So I cannot emphasize how important your cash balance is to your business. That does not mean you need hundreds of thousands of dollars in cash in your checking account at all times. That just means you need an appropriate amount of cash, and you need to be confident that going forward, your business is going to continue generating sufficient cash for you to continue operating. So, one question with cash is, where are you in your annual cycle? Many businesses have seasonal fluctuations. Some businesses consider themselves seasonal businesses, in which case they may have huge seasonal fluctuations, but almost every business has their busy season and their slower season. And so take those seasonal fluctuations into account, because they will tend to affect things like your cash. During your slow season, your cash is likely to decline, A, because you don't need it, B, because you may be stocking up on inventory for your busy season, and C, because you are not getting as much revenue during this season, so your expenses may be a larger percentage of your revenue than they are during your busy season. So the big question about cash is the current balance adequate? Now, what the heck do I mean by adequate? Um, well, an adequate balance is one I would propose that lets you sleep well at night. It gives you confidence that your business has enough cash for upcoming needs. And what determines that? Well, for many businesses, the first place to look is your payroll. Do you have enough for your next payroll? Or perhaps even your next two payrolls? Once again, I go back to that notion of what balance helps you sleep well at night. If you're about to make some big inventory purchases for an upcoming busy season, do you have enough cash to meet those needs? And also, if you have accounts receivable because you are offering terms to your customers, do you have enough in cash right now to get you through the next bit while you're waiting for your past customers to pay you? So cash is the most useful thing to keep track of, but as long as you have that minimum comfortable level, you're probably okay. Next one, just below cash on your balance sheet, is your accounts receivable. And accounts receivable represents the amounts that your customers owe you for products they've already purchased, but not yet paid for. Some small businesses who manage their accounting on a cash basis may not have accounts receivable because they only take cash for everything. But if you allow somebody to pay later, you will have an accounts receivable. And therefore, it represents an asset because you expect to get that cash within 12 months, which makes it a current asset. But it's cash you don't have yet. So if you're a growing business, every dollar that's in accounts receivable is a dollar that you do not have to invest in inventory if you need that for growth, or to invest in more marketing if you need that for growth. So what's in your accounts receivable ties up your cash. Things to think about. Have accounts receivable grown faster than your revenues during the same period? You'll have to look at the income statement to see how fast your revenues grew, but it makes sense that your accounts receivable would grow in line with your revenues, but there are times when it might not. For example, if you've just started offering terms to some of your clients, then accounts receivable are likely to grow faster than revenues. If you've opened a new line of business, which does or does not offer terms to your customers, you might find your accounts receivable changes rather dramatically as a percentage of your revenues. As long as you know why it's happening and you're okay with the proportion of revenues it represents, that's okay. What's important is to be aware of what level seems reasonable for what you're doing with your business. The more money that's tied up in accounts receivable, the less money you have in cash. So keep a careful eye on it. Monitor any accounts that are overdue. In fact, that is the key thing to monitor with accounts receivable. Look at your aging of accounts receivable report, and anybody that's overdue, communicate with them. It's not necessarily always the most important thing to have people pay exactly when due. You want to maintain good customer relations. But if they are overdue and you didn't know they were going to be overdue, then reach out to them and say, hey, I noticed you're late with this month's payment. What's up? It doesn't have to be confrontational. You don't have to be demanding. You just want them to know that you know that this payment is overdue, that you're expecting it, that your business depends on it. At the same time, if you wish to be understanding and give them a little more time, that's your prerogative as the business owner. But every dollar that's sitting in accounts receivable is a dollar that you do not have to help you operate your business. And your business can get into deep trouble if too much is tied up in accounts receivable in a way that you did not plan for. Some businesses have to get a bank loan to finance their accounts receivable, which means that accounts receivable is costing you money. Even if you don't have a bank loan, money tied by accounts receivable may not be earning interest if you have an interest-bearing account, and therefore would be costing you money. If it's preventing you from ordering more inventory and therefore you run out of stock, it's costing you money. So monitor your accounts receivable closely and don't offer your customers terms unless you need to. Some businesses, it really is a necessity because that's the way it's done in that industry. In other businesses, it's not. Third account, your inventory. Now, some businesses have inventory, some businesses have significant inventory, and other businesses don't have much inventory at all. No matter what kind of business you run, inventory consumes your cash because you have to pay money to buy it, and it may cost you money to store it for the square feet that it consumes, for any climate control that it requires, and for the staff labor needed to put it on the shelf and go find it again later. So carrying inventory in general will cost you money, maybe not a lot, but in most cases, it's money that you are happy to spend because if you don't have the inventory, you can't make the sale. If you're in one of those businesses like a drop shipping business where you never take possession, then maybe you don't have to maintain inventory. Cool. That's a wonderful thing. But in general, inventory consumes cash to buy and store. And with everything I just said about cash, you therefore wish to be careful about your inventory level. Too little inventory can hurt your ability to generate sales, so that can be bad. But too much inventory ties up your cash, which can also be bad. So finding that optimal inventory level can be challenging and also can require experience if you're a new business. If you have seasonal needs, your inventory may need to rise in anticipation of your busy season and then should decline when you're not going to need to have that much inventory for your slow season. Once again, the big question, just like accounts receivable, has inventory grown faster than revenues? And if so, did it need to do that? Sometimes people are just ordering out of habit. Oh, I need to place this order every month. And they may not have noticed that sales in certain items had declined. Maybe you don't need that much inventory in those items. So if you can, look at inventory by item versus sales of that item to see whether inventory has grown faster than your revenues. And that can help you keep inventory levels aligned with your current business volume. How much inventory is enough? Well, that's for you as a business owner to decide. If you're running out of inventory and therefore losing sales, you probably don't quite have enough of those items. But you really need to look at inventory on an item by item basis in order to judge whether the quantity on hand is sufficient for your current volume of business. So a lot of money can be tied up in inventory for some businesses, not so much in others, and none in others yet. So if you're in a business that requires inventory, keep a close eye on it. Use your accounting software or your inventory software to help you track it carefully and make sure that you always have volumes that you feel are appropriate on hand. Many businesses will have sales to clear out inventory that they don't wish to consume the space to store, or just to free up the cash that's in there. If you sell it at no profit, you're getting the cash back. You may not get the profit, but you're getting the cash back and you're getting the space it consumed back. Next up are your fixed assets. And the reason that fixed assets are important to look at on a regular basis is because they do consume cash to purchase. So if you buy a fixed asset, that is going to use up part of your cash. If you need that asset, great, you needed that asset. However, The tricky thing is that a lot of people are used to monitoring something I'll get to in a little bit, which is your profit. And buying a fixed asset is generally not an expense. You're going to end up usually depreciating it if it's a long-lived asset. And so its cost is going to become a gradual expense over time for the life of the fixed asset on your income statement. And as a result, you may see that you had perfectly reasonable profit this month, but my cash took a big hit. What happened? Well, if you bought a fixed asset this month, you may find that that's where your cash went. So the reason to keep a close eye on your fixed asset changes is because that can be either what produced a bundle of cash if you sold an obsolete piece of equipment, or consumed a pile of cash if you bought something. So a change in your fixed assets between previous period and now is often one reason for significant changes in cash. Now, a related theme is when you're considering acquiring a new asset, it is often worth considering whether you wish to rent or lease it instead of purchase it. And the reason for that is that if you are finding yourself having to watch your cash very closely every month because it's a little low when you're a little nervous about it, if you buy a fixed asset, that will consume your cash and it's gone. Whereas if you can rent it or lease it, you're making much smaller payments on a monthly basis. And even if it costs you more in the long run to rent or lease, that may be better for your business because it preserves your cash balance in the near term and gives you the cash that your business needs to operate. So there's no set rule as to whether purchasing versus renting or leasing is better. Much will depend on your business's current cash balance and whether it's more than adequate or just adequate. If it's more than adequate after you made the asset purchase, then cool, go ahead and buy it and spend less money. But if you're worried about cash balances, and yet you need a fixed asset, a piece of machinery, a building, whatever, consider leasing it as a way to preserve your cash balance. Even though that may slightly diminish your profitability, it may help reduce the riskiness of operating your business. So having a certain minimum available cash balance may be more important to your business than purchasing at the lowest possible cost. That's a subtle idea to keep in mind, but an important one. Turning to the liabilities side of your balance sheet, your accounts payable are another account to monitor. And I just noticed a typo, which should say liabilities and equity at the top there. So accounts payable are something that as a new business, you may not have. If all of the vendors that you purchase from demand that you pay in cash at the time of purchase, then you will not have accounts payable and there's nothing to worry about. However, if that vendor were to offer you terms, say, oh, you can pay me 2 weeks after I ship it or something like that, that would be 2 more weeks that you could hold on to that cash. And therefore your cash balance would be better for those 2 weeks and you would sleep better at night for those 2 weeks. So if a vendor offers you terms and you take advantage of them, that is another source of financing for your business. That might mean you don't need to go for a bank loan. How cool would that be? So if you have vendors with whom you have been doing business for some period of time, maybe 6 months or a year or longer, and they're not offering you terms, it's perfectly reasonable for you to say to them, hey, I've been a good customer of yours for a while. Would you consider offering me terms? And they might say, well, you have a choice. Either I give you a volume discount or I give you terms. Okay, that's a choice you can make. Or they might say, sure, be happy to offer you terms. They might not give you the most generous terms, but it's better than nothing. If they do offer to let you pay later than when the product is shipped, then you probably want to have a system in place using your accounting software to enter an invoice when you receive it and have your accounting software remind you of when that invoice is due so that you can always pay it on time. You want to honor those terms. You're grateful to that vendor for helping you finance your business. Thank you. And so if you get terms from a vendor, try to honor them so that they continue to extend terms to you. And if you have software that can help you keep track of all the invoices and when they're due so that you can pay them on time reliably, that is probably a good thing to take advantage of. Because if you receive terms from your vendors but don't pay on time, they may not continue to offer them, and there goes that source of financing. So if you have accounts payable, monitor it closely and make sure you're paying on time. If you don't, you might risk losing terms extending, vendors extending terms to you. So to summarize the balance sheet items, are your cash levels comfortable? Are you collecting accounts receivable on time? That's usually the greatest risk to accounts receivable is they get away from you by not being paid on time. You can control that if it's a regular customer by not accepting their next order until they pay for the previous one, for example. Are inventory levels as needed for your anticipated upcoming sales volume? Do you need to purchase fixed assets? And if so, do you want to purchase them outright, or would you perhaps be better off looking into renting or leasing them? And lastly, are you using your accounts payable effectively and paying them on time or not? Those are the key questions that I would ask about the balance sheet accounts that we've just gone through. Any questions on all of those? You all have been amazingly silent. Okay. You're welcome to put questions in the chat or just unmute yourself and jump in. Either way is fine by me, but I do welcome your questions. Moving on to the income statement. Your income statement shows your income and expenses and calculates your profit or loss, but it does so over a period of time. Whereas a balance sheet is a snapshot at one point in time, the income statement is always an accumulation of results over a period of time. So as with the balance sheet, you get to determine how much or how little detail your income statement shows. So with organizations which I've been a treasurer, I often show one level of detail for the board to review, but I show a much greater level of detail for management to review. The board is after the big picture, management's after the details. So both are important. Even if you're managing your business, while you need to know details at times, at other times it's probably better to look at the big picture. And sometimes having groups of accounts that you collapse into a total can be more useful to help you spot trends that may be hurting your business. If you've got 6 accounts under utilities, say, and each of them is up by a little bit, none of those small changes might attract your attention. But when added together and you see what happened to total utilities, you might say, ooh, that's a bigger change than I expected. So sometimes you will have insights from looking at totals that you might not have from looking at sub-accounts, particularly on things like the income statement. So on the income statement, we'll start with revenues. Your first question is, did your revenues meet your expectations? If you have goals for your business, that's a good thing. And you're always trying to judge whether you are likely to meet your goals or not for the year. And so that's the first question about revenues. Was it what I expected? If you track your revenues by various sub-accounts, for example, by type of product or product sold versus services offered, if you track things in different revenue accounts, then you might wish to look at each account's percent of total revenues. And has that changed from the same period last year? If so, was that something you expected? And if not, why has it changed? That might help you spot changes in your marketplace. An interesting question is, how fast did your revenues grow or shrink? Once again, was this something that you expected, or was this a little bit of a surprise? If you understand why they behaved as they did, cool. If you don't understand why they behaved as they did, it's something to look into. And the reason I say all of this is because if you are a growing business, which many small businesses are, if your revenues are growing faster than your net profit margin, that can require cash, particularly if you're in a business that uses inventory. So the idea here is, if your revenues are growing at 10%, but you've got an 8% net profit margin, you're not earning enough profit to fund the growth in inventory that you may need to continue growing your business. So if you're looking at projections for your business and you see that your sales growth rate is faster than your net profit percentage, then you may need financing in order to grow your business, unless you have a really healthy cash balance. So growing a business can suck the cash out of the business if it's not profitable enough. And you need to watch out for that if you're in a growing business. Another reason to watch the cash balance on your balance sheet. Next up is your gross margin. And gross margin is sometimes shown on income statements, sometimes not, but it's easy to show in a spreadsheet if it's not shown by your accounting software. Gross margin is defined as sales minus cost of goods sold, or cost of sales. The cost of sales is something that confuses a number of people, in that it includes all of your costs from purchasing products or making products, as well as keeping them in inventory. So those are all costs of goods sold. And in general, those are considered to be variable costs, meaning they tend to vary by the exact same percentage that your revenues varied during the period. If your revenues doubled, your cost of sales probably doubled too. And so your gross margin is the dollar value. So in this example, on the income statement, your gross margin is $160,000 in 2022 and $195,000 in 2023. Your gross margin grew by 22%. That's awesome, particularly in light of the fact that your sales only grew by 8%. So your business looks like it's been a lot more profitable. Well, why? Well, if you look at the cost of sales, you'll notice the cost of sales only grew by 3.4%. Maybe you got a discount from one of your major suppliers. Maybe you switched vendors, but clearly you controlled costs very well while your sales grew. and the result was an improvement in your gross margin. What is gross margin? Gross margin is the gross profit that you have to pay all your other expenses that were not necessarily directly related to the sales you made.
Whit,
Yes.
Frank Yonner, in cost of sales if you're manufacturing a product, should the direct labor that goes into that manufacturing be shown as cost of sales?
Yes.
Okay.
So every payroll that goes into paying people who work to produce the product, all of that will go into inventory and then come out of inventory as cost of sales or cost of goods sold when the product is sold, providing that you are using inventory and also that you are using accrual accounting. If using cash accounting, you might just deduct all of those expenses at the time they're incurred. But if you are putting stuff in inventory, then in general, you are going to put not only the cost of the raw materials, but also all the labor that went into manufacturing it into inventory. And then that amount will grow with the cost of keeping the inventory until such time as you sell it. So it can be complicated to track the full cost of inventory. If you turn your inventory quickly, it's sort of irrelevant. If you sell everything you make every month, this is all relevant. But if you find that things stick around in inventory for 3 months, 6 months, 9 months, then this may be very relevant.
Thank you.
Any day. So if your gross margin shrinks as a percentage of your sales, the opposite of what is shown here, then that means that your prices are not keeping up with your costs, which is typical in inflationary times. Therefore, that's a warning that you need to look carefully at either your costs because they're going up or your prices because they are not keeping up with your costs. Whether you increase your prices or find another vendor to try to reduce your costs or, that's your choice. But you need to be acutely aware of what your options are and whether this is acceptable to you or not as a person running the business. So pay careful attention to your gross margin as a percentage of sales. That's the 21.9% in this example here. It's gone up by 21%. The gross margin percent of sales is the 27% and the 30% in this example. And so in this case, it has grown from 27% last year to 30% this year. That's awesome. That's good. That means I have more money to cover other expenses, not only from the growth in my gross margin, but also from the fact that I'm earning a little bit more on every dollar of revenue. So if it declines and you expected it, that's fine. If it declines and you didn't expect it, that's a surprise, and you want to dig into why that happened. Joe asks, how do you address the cost of sales in a service industry for a sole proprietor? Well, in a service industry, cost of sales is going to be all the labor that went into generating the revenues you got from the services. So there would be two kinds of labor. Just for example, suppose I'm operating solo. I'm a consultant. I bill for my time, and the net result is at the end of the month, say, or the year, I have a whole bunch of my time that was billed, but then I also have a whole bunch of my time that I spent on administrative things like preparing invoices and sending invoices and doing my taxes for the company and all that kind of stuff. So I really have two kinds of time that I probably want to report on my income statement if I'm going to be able to measure my business results fairly. The time that was spent on client projects helped me figure out whether I quoted that project well or not, and was that project profitable or not. So I do want to track the time I spent specifically for clients against each of those client projects. And all of that time would appear as cost of sales. All my other time spent landing new contracts, managing my books, and things like that would be considered administrative time and overhead time and would appear further down on my income statement. So, yes, if you're in a service business, time that went directly to generating that revenue would be accounted for under cost of sales, but other time that was for overhead or general business purposes and not specifically for certain revenues that you received would be below the gross margin on your income statement. Does that address your question sufficiently, John? Kathy asks, where does advertising cost fit in? Chamber memberships? No, those are not costs of sales. This is something that surprised the daylights out of me the first time I learned this, which is suppose you pay commission to your salespeople. The commissions that you pay are not cost of sales. The salary of your salespeople are not cost of sales. They are all overhead. Your marketing expenses are not cost of sales. They are overhead. It's only the cost of acquiring the product that you resold or the cost of the labor that was required to directly generate those revenues. So if you're a contractor, the time that your carpenters spent on site is cost of sales. The time that your carpenters spent back in your shop learning new skills or getting up to speed on new standards, that is all going to be down below gross margin under administrative labor costs. So only costs that were directly involved in delivering that product or service to the client count as cost of sales. Selling costs, marketing costs are all considered overhead, including sales commissions. So,
Wow.
yes,
Thank you.
any day. It's a little surprising, but sales compensation packages are all over the board. Some salespeople get a salary, so you could argue that's not directly related to the cost of selling that customer. But in general, cost of goods sold is intended to be the cost of the good or service directly, and the selling process is considered administrative. Just as in a retail environment, the person standing at the checkout line at the cash register is really an overhead expense. You cannot really consider them to be the cost of providing that inventory to your customer. So, one big question is, do you want to track your gross margin by product type or service type? In which case you might have to have multiple revenue lines and multiple cost of sales lines so that you can track the gross margin by each of those product types or service areas. That's more work on the accounting side, but that gives you more insights as to where your business is more profitable versus less profitable. And if there's a change in your gross margin, as in this example, it grew by 3% compared to last year, which is awesome. The immediate next question is, was this a one-time thing? Did I get lucky this month? Did I buy a certain pile of things at a deep discount? Or is this a trend that I expect to continue? That's a really important insight to have for your planning as you turn to look at next year or next period even. Next up is your net margin. And net margin is after all your overhead wages, administrative functions, sales, marketing, etc. Custodial staff would generally be, custodial staff for your administrative offices would generally be an operating expense. Custodial staff for the factory, if you're a manufacturing business, might indeed be considered cost of sales. talk to your accountant about those sorts of questions. It can get tricky. I'm not an accountant. So the big items for many companies are payroll, utilities, depreciation if you have fixed assets, and they can add up. Now, in this case, in this example, I want to fit it all on one page. So I lumped a lot of things like insurance and utilities and rent under other expenses. That probably is not very realistic for most people, but that's what fit on the page easily. So that's what we have here. But usually your operating expenses are a list of between 10 and 20 items. It doesn't have to get down to the paperclip level. I generally recommend that they be numbers that are above some minimum dollar amount because it isn't worth paying attention to small accounts. Pay attention to the big numbers. Anyhow, so once you subtract all of your operating expenses, you end up with your net margin. And this is the profit that you've made after all of your expenses, except for taxes, which would be coming up next. So similar to looking at gross margin, look at your net margin as a percentage of sales in that period. So the very bottom line on this chart shows that your net margin grew from 7% last year to 9% this year, which means you are more profitable on a percentage basis than you were last year, which generally means that you're operating your business better. Not only that, because your revenues grew, your profit dollars grew, in this case, by 53%. Whoa, that's awesome. Anyhow, net margin is defined to be gross margin minus all other expenses. And you will probably find that some of your operating expenses are still revenue dependent, such as sales commissions. If you don't sell much, your sales commissions will be low. If you sell a ton, your sales commissions might be high. And so that is something which varies directly with revenues and would be a variable expense. But many other operating expenses will be fixed expenses, like rent or depreciation. Your utilities may be largely a fixed expense for at least for your administrative offices. If you have a manufacturing plant, the utilities for manufacturing would probably be up under cost of sales. Questions. Did your net margin change as a percent of sales? If so, why? Was it exclusively because of gross margin changes? Or was it also because of operating expense changes? Or perhaps it was both? In this case, our gross margin grew from 27 to 30%, and our operating expenses grew from 20% of revenues to 21% of revenues. So I didn't really control my operating expenses as well as I might have hoped relative to revenues. They grew by 1%. So that might be something to watch. That said, they went up by 11%, while my gross margin went up by 21%. So I've got plenty of profit to cover that. However, notice total operating expenses went up by 11%, while sales only went up by 8%. So my operating expenses were growing faster than my revenues did. And therefore, in this example, that's something to potentially watch. Why did this happen? Can I control it better going forward? So that's the central question. Why? Do you understand why these numbers changed as they did? If it was for a good reason that was unavoidable, fine. Don't beat yourself up about it. If it was expected, all the better. But if it's a surprise, you may need to focus on that area of your business to make sure that it doesn't get out of control going into the future. So in looking at your income statement, understand why your revenues changed as they did. Monitor your gross margin to make sure that you're not experiencing supply costs that are creeping up and not keeping up with it in your pricing. And also monitor your net margin to ensure that your total expenses are keeping in line. In inflationary times, it's a constant dance with gross margin and net margin sometimes surging ahead just when you least want it. But say you had to offer a salary increase to a bunch of people, that might impact gross margin and net margin. You know why it happened. You know you had to do it. Therefore, it was expected. Okay, is your business going to have enough cash going forward anyhow? That becomes the important question. So when you make tough decisions, be aware of their financial implications. Look for them in your financial statements, and then make sure that they were in line with your expectations. Any further questions on the income statement? Okay. I'm just going to mention your cash flow statement briefly. Your accounting software should be able to generate a statement of cash flows for you. And it shows the change in your business's cash balance over a specified period of time, just like the income statement does. Except the income statement is really focusing on profitability, which is a very different thing than your cash balance. For example, if you buy a new truck, if you bought it for cash, that consumes a pile of your cash, but it has a much smaller effect on your profitability. Only the depreciation on that truck for the year will reduce your profitability that year, unless you're a small business using Section 129 and you expense the whole thing in 1 year, in which case that does affect your profitability. But for most businesses that buy fixed assets and then depreciate them, you'll find that there's a potentially big difference between what your profit is for the year and the change in your cash. If you just got a big bank loan but haven't spent it all, that also will be a huge cash infusion, but you won't necessarily show profit. If anything, your interest expenses go up by a bit. So looking at your cash balance is a very different thing from looking at your profitability as a business. So it is generally important to look at both your income statement and your statement of cash flows. You use the income statement to understand if you're operating profitably over time, and you use your cash flow statement to make sure that you understand where your cash has come from or gone to. So you may have had a new investor, or you may have done an owner's draw, or you may have repaid a loan or received a loan, or purchased some fixed assets, or sold some assets you didn't need anymore. All of those can affect your cash balance in ways that your excuse me, that your income statement do not explain. That's why the statement of cash flows is needed in addition to your income statement. Here's an example of, once again, a simplified statement of cash flows. Notice that it starts with net income. This will be the exact same number you saw in your income statement. It adds back depreciation because that's a non-cash expense. And then it goes through your balance sheet. And for almost every account on your balance sheet, a change in the balance of that account will cause a change in your amount of cash. So every change in a balance sheet account is then reflected on here. And this provides a quick summary in one place of all the items that affected your cash balance. It ends generally by saying, what did your cash change by during the year? In this case, 15,000. And you can see that if you look at your cash balance at the beginning of the year and the end of the year, Yep, it changed by 15,000. But wait a minute, my net income was 60,000. How come my cash only went up by 15? Well, all of the things in parentheses, the negatives here, explain that. Oh, I repaid a line of credit. Oh, I repaid some long-term debt. Oh, I took $20,000 out of the business for myself. So all of those reduce the amount of cash in the business. So don't ignore your statement of cash flows. I will say that I've often gone to a statement of cash flows in an effort to explain why a cash balance has changed significantly over a period of time, and found that it's sort of a death by 1,000 cuts kind of thing. There's so many factors explaining the change, some of which offset one another, that it can be really challenging sometimes to say, oh, my cash changed by 15,000 because. Of all the things listed here, what would I list as my because? Well, clearly 60,000 went out due to financing activities and 30,000 went out due to purchase of equipment, but 105 came in due to operations. So net income was good, but I spent some of that in allowing accounts receivable to grow by $40,000. But then I got some of that back because I managed my inventory more tightly, and I have $25,000 less inventory than I had at this time last year. And I've got 25,000 more cash because I'm using accounts payable, and it's a little bit higher this year than it was this time last year. So, what are the reasons that I ended up with only a $15,000 increase in cash? Well, they're complicated. And what one hand giveth, the other taketh away. And it can be complex to try to explain in a simple way exactly what happened. So if you find yourself finding a simple explanation of why your cash changed as it did elusive, you have lots of company. But the statement of cash flows does explain exactly where it all came from and where it all went to. And it can be complicated. So fear not if you find that a little confusing.
Hey, Whit, Frank
Yes.
Yonner again. When I operated my business, the cash flow report was one of the key reports due to the fluctuations in terms of business. I found that using past activity, then projecting forward, which is really one of the real uses for all these reports, is pro forma projections. That allowed me to predict where I would have big hits in cash flow, so I could prepare for those.
Yes. And I love cash flow projections. They are wonderful things. That's a whole other workshop topic, because a lot of people who don't have experience making projections can find a number of things either feel daunting to them, or the most common thing I've found is people feel that obligated to have their projections be correct.
Yeah.
And they're a projection. Of course, they're going to be wrong. And when you realize that nobody expects your projection to be right, the question is it too high or too low? Everybody expects you to do the best you can, and expects you to state your assumptions and to make reasonable assumptions. But particularly projecting your cash flow out 3 months, if 6 months is too much for you, but 3 to 6 or even 12 months lets you manage your business more proactively. And if you want to go for financing, it's much easier to do so well in advance of your needing it. And a cash flow projection is going to be needed to obtain financing, but is also going to be what tells you that you are going to need financing coming up. Mm-hmm. So pay attention to your statement of cash flows. And I heartily endorse and recommend doing cash flow projections out 12 months if you can. Yep. To manage your business better. So reconcile your financials every month. Don't let that slide. When you get your bank statement, your credit card statement, make sure those are reflected in your accounting software. And then as soon as they're reconciled, look over your financials as I've been describing today. Quickly review these 8 key accounts. I think you'll find that the first time you do it, it may take you a while as you think through all the issues related to it. But if you do it every month, I think you'll find that after 3 or 4 months, the review might only take you 5 minutes, unless it raises questions, in which case it could take you hours chasing down those questions. But those are presumably hours well spent because they're helping ensure that you understand your business better. And when you get this slide deck, you will be receiving a copy of the slide deck in your email. The underlined links on the slides that describe what's a balance sheet, what's the income statement, what's the statement of cash flows, will take you some blog posts that provide more detail on those statements if they're statements that you'd like to be more familiar with. They're not very detailed blog posts, but at the bottom, they also include links to other resources on the internet that can provide more detail if you wish. So if you're looking to become more comfortable with your financial statements, follow those links in the slide deck. I'm happy to answer more questions. I'm able to stick around for a while if you want to keep asking away or dive into some more details. But if you don't, you should receive an email survey. Please respond to it. We take all survey responses very seriously. And if you wish to find upcoming workshops, you can click on this link. And if you wish to work with a SCORE mentor, well, we were founded in 1964. We offer free mentoring and workshops. We're a nonprofit. We're a partner of the Small Business Administration, and we have 320 offices throughout the United States. So there's probably several chapters in your state that will be happy to work with you on your business questions. So if you want to sign up for a mentor, you can scan this QR code and go straight to the screen that lets you sign up for a mentor. That's all I have to say. If you have questions, as I said, I'd be happy to address them now. You're welcome, Kathy. You're welcome, Wayne. Thanks for coming. See you, Joe. Okay, not seeing any questions. I will end this workshop. Thanks again, and look forward to seeing you again in a future workshop. Oop, there's one from Tony. If your sales-only business, a broker for machinery, then commissions will be part of your cost of sales. In general, commissions are not, under generally accepted accounting principles, commissions are not considered cost of goods sold. Only direct labor that went into producing the product that is sold. Okay, so if you are a broker, then you are basically an all overhead business.
Gotcha. So there's no cost of sales that you wouldn't then calculate cost of sales. Okay.
Right. Now, that doesn't prevent you from, in your accounting software, if it supports this, if you're using QuickBooks, you can track things by classes, and you might have each project be its own class. And in doing that, you can track your expenses by project and make sure that each one was profitable for you. And that's really a separate question from looking at gross margin versus net margin.
Okay, thank you.
You're very welcome.
Interesting and beneficial.
Happy to help. Have a great day, everyone.